So if you've ever dabbled in the Indian stock market, you know it's not just about the buy and sell price, right? There are other costs. But what you might not realize is that beyond just the brokerage fees, there's this whole other world of taxes. And these taxes, they can have a huge impact, not just on your wallet, but on the entire market. So today, we're going to pull back the curtain on the hidden taxes lurking in your trades. All right, look at this number, 78,000 crore rupees. Just let that sink in for a second. That is the absolutely massive amount the Indian government is projected to collect from just one single type of tax on stock market deals in just 1 year. It's a staggering figure, really. So you see a number like that and you've got to ask, right? Where on earth does all that money come from? Well, spoiler alert, it comes from investors and traders. And in this explainer, we're going to break down exactly how it works, why it's set up this way, and maybe most importantly, what the unintended consequences are. Okay, so to really get our heads around this, we need to meet the two main players in this game, the two key taxes on your investments. Now, they might sound kind of similar, but trust me, they operate in completely different ways. So on one hand, you've got the capital gains tax. This one's pretty straightforward, right? You make a profit, you pay a tax on that profit. Easy enough. But on the other hand, you have something called the Securities Transaction Tax, or STT. Now, this one's different. Think of it less like a tax on your winnings and more like a toll booth on the financial highway. Every single time you drive through, meaning every time you buy or sell, you have to pay. It doesn't matter if your trip was profitable or not. You pay the toll. So let's circle back to capital gains tax for a sec. The key word here, the only word that matters really, is profit. It's the money you make on top of what you originally put in. No profit, no capital gains tax. Simple as that. And this applies to all sorts of things. Stocks, real estate, mutual funds, you name it. STT, though, that's a whole different beast. It's a direct tax, and it's levied on the act of trading itself. It was brought in back in 2004, and the idea was, to have an efficient way to collect revenue and maybe cool down some of the wild speculation. But the big takeaway for you is this. It applies to the total value of your transaction, whether you win or lose. Okay, let's jump back to capital gains for a minute, because there's a really critical distinction the tax authorities make. And honestly, it all boils down to one simple question. How long did you actually own the asset? See, if you hold on to an asset for a certain minimum amount of time, they call this the holding period. Any profit you make is considered a long-term capital gain, or LTCG. And here's the kicker, the big advantage. These gains are usually taxed at a much, much friendlier, lower rate. But, and this is a big but, if you sell before that minimum holding period is over, your profit gets slapped with a different label, short-term capital gain, or STCG. And you guessed it, this is typically taxed at a higher rate. It's basically the government's way of nudging people towards long-term investing instead of quick, speculative trading. Now, of course, it would be too easy if the rules were the same for everything, right? So let's take a quick look at the fine print and see how this all plays out for some of the most common things people invest in. Just look at how different these rules are. For stocks you buy on the exchange, you only need to hold them for a year, 12 months, to get that nice, lower, long-term rate. But for something like a debt fund or a piece of property, that holding period doubles to 24 months. And the tax rates, they're all over the place. Now this difference in the rules, this is where our story starts to get much bigger than just your personal tax return. Yeah, because these taxes, they don't just hit your bottom line. They create these powerful incentives and disincentives that send ripples across the entire financial system. They actually change the behavior of millions of investors in ways you probably wouldn't expect. In this quote right here, it just hits the nail on the head. What it's really saying is, when you make one type of trading way more expensive than another, people don't just stop trading. Nope. They move. They migrate to the path of least resistance, or, in this case, the path of lower taxes. And if you want proof, look no further. This chart is, well, it's stunning. That flat green line at the bottom, that's the cash market, where you buy and sell actual shares of a company. See how it's barely moved? Now look at those other two lines just rocketing upwards. Those are options and futures, the derivatives market. I mean, the difference in growth is absolutely wild, and it's a direct result of these different tax rules. But here's the thing. This great migration, it isn't just happening within India's markets. It's happening out of India. Check this out. This chart shows the trading volume of Nifty futures on this Singapore exchange as a percentage of the volume on our own NSE. In just 4 years, it more than tripled. Traders are literally taking their business and moving it overseas. The big question is, why? Well, this slide right here explains a whole lot. In India, the mandatory costs, driven mostly by that STT toll booth we talked about, make up a mind-boggling 98.5% of the total cost of a trade. 98.5%. Now look at Singapore. It's just 6.5%. When you're looking at a difference that huge, is it really any surprise that a huge chunk of trading has packed its bags and found a new home? And that move has very real consequences back home. This number, 29.2%, that was the NSE's turnover ratio back in 2012-13. A decade before that, it was over 200%. So what is a turnover ratio? Put simply, it's a measure of market liquidity, basically how easily you can buy or sell something without affecting its price. A huge drop like this is a flashing red light, a warning sign that the market is getting less fluid, and that can make it harder and more expensive for everyone to trade. So what we're really looking at here is a classic policy dilemma. It's this incredibly high-stakes balancing act between two very important and sometimes conflicting goals. All right, so let's tie this all together. For the government, that STT is a massive, reliable, and frankly, easy-to-collect source of revenue. We're talking about that 78,000 crore number. But for the market, that very same tax creates weird distortions. It can hurt liquidity, and it literally pushes trading overseas. And for you, the investor at the center of all this, understanding these taxes is absolutely crucial if you want to figure out your real returns. And all of this leaves us with the one big, open-ended question that's at the heart of this entire debate. What is the perfect balance? Is it even possible to have a tax that's high enough to help fund a country, but low enough to make sure its own markets stay healthy, competitive, and thriving? Finding the answer to that, well, that's the real challenge.